Hi folks, and welcome back to Meaningful Money. Okay, I'm still here at Porthgwara. Beautiful sunny day, very windy though, so I'm tucked right in behind the rock here. The beach is about 10 foot down there, okay, a bit of a drop, but we're out in the wind and that's the main thing. The sea is noisy though, but hopefully the Thai mic is cutting that out a little bit. We're going to move on now to a new series, just a mini series on advanced investing, and I've been asked to do this by a few people on the site who have made comment. So thank you to you guys for giving me some material. Always happy to receive that. So we're going to look at some things like venture capital trusts, enterprise investment schemes, film partnerships, contracts for difference. These are the sort of sharp end of the investment world, not for everybody by any means. Okay. Before we get into it though, as ever, I must thank my very good friends at 7 Investment Management, who are down here, who sponsor the show and help me keep going. Now, we're going to look today at venture capital trusts. Okay. Now, a venture capital trust, or a VCT, as it shall henceforth be known, is basically a company. Okay, it's a company whose shares are traded on the stock market, and you, the investor, buy shares in that company. But the sole purpose of this company, rather than sort of making widgets and selling them or offering services, the sole purpose is to buy shares in smaller companies, to nurture those companies with advice and skills, to grow those companies, and then to sell those companies and float them, thereby making a profit. So these are small fledgling companies usually who need money to grow and need help and advice. Venture capital trust manager comes in and buys a chunk of shares, a chunk of shares from this company and grows it eventually to sell those shares and make a profit. Okay, so the government or the Inland Revenue wants to help grow the economy. And they want you to help them do that. And so in order to do that, they will offer you certain tax breaks. Now, we'll get back to those in a minute. Okay. But these are small companies, or at least small-ish, perhaps might be a better phrase, because these are companies worth less than £15 million altogether. It used to only be 7 million, now it's 15 million, with less than 250 employees. So they're small-ish, okay? I mean, you know, I got sort of 3 employees. And worth a lot less than 15 million quid, you know, so where I'm a small company, but these are smallish companies, right? But they can be grown and nurtured and then sold for profit. For you, the investor, though, it's all about the tax breaks, and that's what the government is giving you to sort of enlist your help in growing the economy by growing these small companies. Okay, the first of those tax breaks is income tax relief. Okay, now you'll have remembered me talking about tax relief for things like pension contributions. Effectively, tax relief means tax back from the revenue, right? In this case, so the magic number is 30% here. So if I make a £100,000 investment, I'm going to get £30,000 back from the revenue. Okay, that will effectively come off my tax bill, right? So that's a pretty big perk. So now I've got £100,000 worth of shares in this VCT, but it's only cost me 70,000. So I'm sitting on a profit immediately. So it's pretty valuable. There's a couple of wrinkles to that though. I have to hold the shares for 5 years, otherwise I'm going to have to give my tax relief back. So that's a pretty important one. But secondly, I must have a tax bill big enough to cover the tax relief from my VCT investment. So if I make a 100 grand investment and my tax relief is £30,000, if through my employment or whatever I've only paid £10,000 in tax, then my tax relief is sort of limited to £10,000. All right, so I'm not going to get the full 30 grand. I'm only going to get £10,000 because that's the extent of my tax bill otherwise. Okay, so 5 years, and you must have paid enough tax to justify the tax bill. And importantly, actually. If my only income is dividends, you'll remember from quite a few videos back, the dividends come with a tax credit. That is not included when working out how much tax relief you can receive on the VCT. Whew, that was pretty technical. Second tax relief you get is capital gains tax. Okay, so if you buy some shares in a VCT and subsequently you sell them, there's no capital gains if you've made a profit. Okay, that's pretty valuable. Any dividends and distributions you receive while you hold the shares are also tax-free. There's a whole raft of tax perks for investing in these VCTs. So who does these, and is there a downside? It's all sounding very good, okay? Who does these? The answer to that question is wealthy people. And the reason for that primarily is because they can usually afford to take the significant risks involved with VCT investment. Remember, a VCT is buying shares in small fledgling companies, which, as a result of their size, have a high risk of failing and going bust. And so a VCT carries a reasonable risk of loss, a high risk of loss really, let's say, call it what it is. And so you need to be wealthy to be able to afford the kind of potential losses you can get on VCTs. The gains can be significant too. This is a high risk investment. And so again, you don't ever do something for tax reasons that you wouldn't ordinarily do. So the people who do VCTs are people with big tax issues, and usually people with big tax issues are people with big wallets, wealthy people, okay? But that's fine. VCT investments are 5 to 10 years, so this is not somewhere you put the money you might need to get out to buy a new car next year, okay? This is the preserve of the wealthy. So that's how VCTs work. Tax relief, very advantageous, but high risk. And that's Advanced Investing Part 1, Venture Capital Trusts. So thanks for watching. I'll see you next time when we're going to talk about enterprise investment schemes.